Every investor sees the same news, the same headlines, the same company results, the same stories about oil prices or interest rates. So why do most people lose money in the market, while a small group keeps making money no matter what's happening? It's not because they have secret information. It's not because they're smarter. It's because they think differently. Most investors react to what they see right in front of them. They see good news, they buy. They see bad news, they sell. Simple as that. But the investors who actually win, they don't just ask what's happening. They ask a different question. Okay, and then what? That one question is the difference between average and exceptional. Today, we're going to break it down so you can start using it yourself. Let's start with the basics. First order thinking means you see something and you react to it. That's it. Here's an example. A company announces great results. Profits are up. Everything looks good. A first order thinker says, "Great results. I'm buying." And honestly, that makes sense on the surface. But here's the catch. By the time you see the headline, thousands of other people have already seen it too. They've already bought. The price is already moved. You're not getting a deal. You're arriving late to a party that's almost over. Second order thinking means you go one step further. Instead of just reacting, you ask, okay, this happened, but what happens next? So you look at those same great results and start asking different questions. Did the company just have one good quarter? Or is this going to keep happening? Were people already expecting great results? If so, this might not even be surprising news. If everyone is buying right now, who's going to buy after them to push the price even higher? See the difference? First order thinking looks at what is happening. Second order thinking looks at what happens because of what is happening. That second step, that's where the real opportunities hide. Let me give you a real example. So this clicks. Imagine there's a conflict in a region that produces a gas called neon. You've probably never heard of it. Most people haven't. But it's used to make computer chips. Without it, chip production slows down. Here's how most people react. Chips are going to be short. Tech companies will struggle. Sell tech stocks. That's first order thinking. And yes, lots of people will do exactly that, which means the tech stocks drop almost immediately. But a second order thinker asks, okay, and then what? Maybe some tech companies already have months of this gas stored up. They'll be fine. While their competitors struggle, those companies will actually gain customers. Then you ask again, and then what? If chips are hard to get, car makers can't build new cars. If people can't buy new cars, they start buying used ones instead. Used car prices go up. So while everyone else is selling tech stocks in a panic, a second-order thinker might be quietly looking at used car companies or the tech companies with big stockpiles before the rest of the market figures it out. That's the whole game. Not reacting faster, thinking deeper. Here's something that trips up a lot of investors. If an opportunity feels obvious, if everyone around you is talking about it, it's probably already too late. Think about the electric vehicle boom a few years back. Everyone said, EVs are the future, by EV companies. Sounds smart, right? And a lot of people did exactly that. But what actually happened? So many companies jumped into making EVs that they started competing against each other. Prices dropped. Profits shrunk. A lot of those stocks didn't do as well as people hoped. The second-order thinker asked, if everyone is building electric cars, what do all those cars need? The answer? Copper, lithium, batteries, and a completely upgraded electrical grid to charge all those cars. Those things weren't getting talked about on the news. They weren't exciting. But the people who invested in those things, the materials and infrastructure, quietly made very good returns. The crowd followed the exciting story. The second-order thinker followed the logic. So, how do you start thinking this way? Here are 3 simple habits. Habit 1, the and then what chain. When you see any big news story, write down what you think will happen. Then ask, and then what? And write that down too. Do it at least 3 times. Most people stop at step 1. Getting to step 3 puts you ahead of crowd. Habit 2, ask who's on the other side. Every time you want to buy something, remember someone else is selling it. They're not doing that for no reason. Ask yourself, why would someone want to sell this right now? What do they know that I might be missing? It doesn't mean you're wrong to buy. It just means you're thinking more completely. Habit 3. Think further ahead. Most investors are thinking about next month or next quarter. Try thinking about 3 to 5 years from now. Short-term panic and excitement create long-term opportunities for patient investors. The trick is being willing to wait. Here's the honest truth. Thinking this way isn't easy. It takes more time. It means sitting with uncertainty while everyone else is busy reacting. But that's exactly why it works. The investors who aren't the ones who react the fastest. They're the ones who see further ahead, who follow the chain of events before the crowd catches up. So next time you see a big headline, don't just ask, what does this mean? Ask, and then what? If this was useful, hit subscribe. Every week we break down ideas like this, finance, markets, and the thinking behind smart investing kept simple. And we'd love to know, is there a situation in the market right now where you've been thinking ahead? Drop it in the comments. See you next time